In today's video, we're going to do a masterclass deep dive into why I believe there will be no recession. Core inflation and inflation rate year on year came out in the past trading session. Last month, core inflation year on year was 4.8%. It came out at 4.7%. This was largely the consensus from Bank of America, Citigroup, JP Morgan, Goldman Sachs, and others. What is interesting is the inflation rate year on year. Last month it was 3%, it came in at 3.2%. Most of the major financial organizations expected 3.3%. I'd like to give Tales from the Man Cave a big call out. Thank you for the thumbnail, my friend. When we look at CPI trends, we can see that blue line, CPI excluding food and energy, came down. Total CPI also came down. The problem was in rent, that red line, as well as the black line, which is services less rent. Housing inflation has been really sticky. You can see that darker blue line there. And we can see a bit of an uptick in core services CPI. But all combined, core CPI came down. Core excludes food and energy items. You'll be starting to hear commentary on disinflation, but is this over-optimistic? Services inflation is now the problem on the radar. We can also see transportation services, shelter, food, in terms of the year-on-year change in the CPI, have been coming up, but whereas there was, in at least July 2023, deflation in energy, used cars and trucks, and medical care services. From the Bureau of Labor Statistics, we can see deflation in transportation costs in July. The big driver of that was airline fares and used cars and trucks. The net effect of all of this is US core CPI posted its smallest back-to-back monthly gain in over 2 years. That, of course, is a really good thing, and you can see it a little bit more clearly here. It's good to see the annual rate of change for the core CPI coming down. This is exactly what we want to see, and later on in this video you'll see exactly why. CPI rent inflation has continued to cool down, with rents cooling for the 4th straight month, with the expectation that deeper declines are on the horizon. Decreases in housing, rental, CPI are very important, and you can see downward pressure emerging. Also, vacancy rates are rising. From an annualized percentage basis, we now have deflation excluding housing costs. It's very unfortunate, but the cost to buy housing is now becoming a luxury. Mortgage applications have been declining, and they're down 57% from the peak. Why is that? Because of the higher borrowing costs. In fact, the 30-year mortgage rate is at the highest level in 23 years. When we zoom out on mortgage applications, we can see they're lower in number as compared to the GFC, the global financial crisis. How is the Fed interpreting this data, and why do I say I believe there will be no recession? When looking at the forward probabilities, there's a very low probability that the Fed will increase rates in the next meeting. They're more likely to hold it steady. There will probably be one more rate increase in November. The Fed is actually likely to start cutting rates in January of next year. We're always looking from a balanced perspective. This means that we just don't automatically assume rate hikes or rate decreases are coming. We run the numbers each day and we follow the charts very, very closely. The charts tell us the truth and the news tells us a story. Rate increases are likely if the labor market strengthens, services inflation takes off more than it is currently. Increased consumer expenditures and increased borrowings could drive up asset prices. Inflation expectations are incredibly important to track. Increased global growth could drive inflation as well. Drought impacts and global warming are harming the food production system right across the planet. This could lead to shocks on food prices. If new wars break out or new supply shocks occur, this could also impact the probability of increased interest rates. This particular article was from June 30th. US drought threatens to prop up food inflation. Droughts cut supply, and with the same level of demand or potentially increased demand, that raises prices. July 2023 was the hottest month on record as heat waves scorched the earth. Literally, heat waves did scorch the earth. And record temperatures are driving food prices higher. And you can see the drought in the Mediterranean from May 2021 to 2022 to 2023. Look how red it's getting. Just from today's news, there were 2 articles. Bone dry on the range, Texas cattle ranchers battle the drought's extreme heat. And US cattle killed by heat humidity during the hottest month on record. This drought is not going away. Food price hikes tend to be lags, so that's something to be aware of. Therefore, what is the Fed likely to do? It's likely to pause in September, hike in November, and cut in January, so far. We can see the current unemployment rate is 3.5%. In the previous month, initial jobless claims were 227,000. Now they're 248,000. This is substantially ahead of consensus and forecast. Increased interest rates, or the cost of money, because that's what an interest rate is. When the costs go up, demand goes down, and we can see business demand for bank loans, the US versus Europe, they're both coming down. If interest rates get too high for certain banks, it can force them under, and that's what we've seen with the banking crisis in the US. We can see here that credit is tightening as the banks tighten lending standards because the interest rates are going up to a point where people can't afford to pay them back. This means that businesses can't grow. If businesses can't grow, they don't employ staff, and this increases unemployment. With all these facts in mind, why on earth would I say that there could be no recession? That is, the markets will continue to go up. Financial markets are incredibly complex and complicated. It's a lot like putting a very, very large jigsaw puzzle together. A lot of people just zoom into one particular piece, maybe that piece that's being held in this picture, and say and make all their assumptions and assertions based on that piece. You can't do that. You need to look at the entire jigsaw. Inside the Masterclass, there are so many videos because each video covers a jigsaw piece of the financial markets jigsaw puzzle. Continuing on, and Masterclass students in LV19, you get my chart. We can see that economies all around the world are recovering, yet China is going through a bit of a lag. There have been a lot of reports about the slow growth and problems inside China. There are also a lot of stories about US and China relations, and to understand that, you need to understand the role of chips. And when I mean chips, I mean semiconductors. Taiwan produces over 60% of the world's semiconductors and over 90% of the most advanced ones. Most of these semiconductors are manufactured from Taiwan Semiconductor Manufacturing Corporation, or TSMC. Until now, most of the advanced chips have been made only in Taiwan. Those advanced chips are at the heart of the AI revolution. This is very important to understand because underneath all of these stories is that dynamic playing out. AI is set to change the entire world, and whoever controls AI will control the world. In news out today, US and China poised to drift further apart after an investment ban. President Biden's orders come on top of a slowing Chinese economy, and you can see that it's in the chart. COVID lockdowns and rising tensions between the two superpowers. Earlier this year, the US put a chip ban on China. And of course, Beijing fought back. This has been occurring for quite a while. This particular article, October 7th, 2022, US restricts semiconductor exports in a bid to slow China's military advance. The key word here, or key words, are military advance. To create semiconductor chips, you need germanium and gallium, and China has a monopoly on both of them. In August, it introduced or imposed export restrictions on these rare earth minerals. This is part of the tit-for-tat trade war between the world's two largest economies. This trade war is about AI. AI runs on microprocessing chips, semiconductor chips. Military strategists and financial analysts understand that China taking over Taiwan is very much on the cards. And in news just out, China Hawk says Beijing could attack Taiwan by 2024. News from yesterday, Taiwan reports second large-scale China Air Force incursion this week. It's no wonder in America growing fears of a war with China are breaking out. And this is also very recent news. I would suggest you keep your eye on what's happening with China, the US, and Taiwan. But if nothing happens at least until later on next year, we would expect a rate cut. Inside the Masterclass, we do deep dives into just about every facet of the financial market system. In TM4, Masterclass students get my live chart here. This chart is telling us a very specific story. As inflation goes up, the markets come down, and after a lag effect, when inflation comes down, the markets start to rally. One thing to always bear in mind, news tells you a story, but the charts tell you the truth. One critical thing to look at is the University of Michigan Inflation Expectations chart. The Federal Reserve, in all of their statements, has made a lot of play to this particular indicator. If inflation expectations get baked into the economic system, it's not good. They'll increase interest rates until people feel that deflation is baked into the economic system. And it seems what they've done is working. When the pandemic broke out, supply chains fractured and broke all around the world. Because the world was highly globalized, this created enormous inflation. What's occurring now is things have gone a little bit too far in the other direction, but soon they'll normalize out. The Masterclass is 30 plus years of knowledge transfer, and Masterclass students in LV24, you get my live chart here. This is about yields and the 30-day federal funds rate. What we saw up to the 8th of March 2023 is the federal funds futures were increasing as we anticipated back then when I did that video. What happened next? The futures started to decay, and what followed that? You may see what Bitcoin did, and also what the S&P 500 also did. They utterly rallied. We always look to the charts to triangulate what we're thinking. And when you see a drop-off again in the 30-day federal funds futures chart here in LV24, that will in all likelihood signify a huge rally. But we do three-dimensional risk management. If we start to see an absolute spike in the federal funds futures chart in LV24, buckle up because it could get very turbulent to the downside. Masterclass students, I would also recommend you keep your eye on LV29, Inflations and Recessions. That chart is provided as part of the Masterclass. You can look at it with real-time data. You'll see that you can track US core inflation rate year on year in that particular chart, as well as the US inflation rate. Another thing to keep your eye on, we are always looking at this probability of the Fed raising interest rates. Right now, it's 11% to raise the federal funds rate by 25 basis points. And we can see this rate has been declining for the last month. 1 month ago, it was 22.3%. 1 week ago, it was 18%. 1 day ago, it was 14%. And now it's 11%. I can hear you say, Ken, I'm still not convinced. How do you know there won't be a recession? Well, there is always a recession at some stage. That's the economic cycle, but not immediately. The chart I'm about to show you will be in LV31, as will be this particular video. The LV31 chart is an absolute killer chart. This chart puts a lot of jigsaw pieces together. We can see that GDP, this very light green line, and GDP, real GDP, are both growing. For you to have a recession, you need 2 periods of negative growth, and that's not happening either in a real basis or a nominal basis as far as GDP is concerned. This is the first tick on the scoreboard, but perhaps the greatest tick is actually the University of Michigan inflation expectations. What you typically see is inflation expectations peak before the GDP recession indicator index peaks. Now, what happens typically around this time? The markets are bottoming out, getting ready for a rally. What happened here in the GFC? Exactly that happened. What about going to the C19 part of history in April 2020? It happened again, at least with the GDP recession indicator index. And what are we seeing with the GDP recession indicator index right here in January of 2022? Well, it peaked, and yes, we did get a bit of a pullback. But what's happening now? Is it peaking again? No, it is not. This is another tick. If we saw the GDP recession indicator just marching higher and higher and higher, I wouldn't dare say that there wouldn't be a recession. I'd be calling one. This is the power of being inside the Masterclass. You get to see these little nuggets, these gems. But we can't just rely on the fact at the moment that real GDP and nominal GDP is going up, that the GDP recession indicator index is coming down, that the University of Michigan inflation expectations is coming down. It's not spiking, it's coming down. So tick, 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 tick. There's yet another measure that we can use, this Global Economic Policy Uncertainty Index. When it starts to spike up, there's turbulence in the market. You can see the sell downs occurring. It can precede a sell down. Being aware of this particular index and this indicator is a really, really good thing. Is there yet another tick in the scoreboard? You betcha there is. Look at this. The Global Economic Policy Uncertainty Index is making lows. This is exactly what we want to see. We're getting a lot of pieces of the jigsaw puzzle aligning. This, of course, doesn't marry up to what the news and media are talking about, and it generally doesn't. The entire purpose of the Masterclass is to get you to think independently from the system. Why is that important? Because when you think independently, you can make your own decisions. You become empowered. So Ken, is that all done? No, it's not. We can get curveballs and black swans, and we must be aware of what they are. We've already talked about China, Taiwan, the US, semiconductors, but there are a few more things. One is on supply constraints. We've seen oil prices just rocket. And oil markets, like credit markets, are set to tighten. Everything's tightening. Actually, OPEC data suggests the biggest shortfall since 2021. Just when you thought it was safe to go outside, just from the news today, a new Omicron subvariant dubbed Eris heralds C19's resurgence. Oh, brother. To make sure that you're gauging the health of the financial system, make sure that you look at the CTKS markup on the Tier 1 charts especially. The Tier 2s and the Tier 3s will give credit and weight to the Tier 1's actions and movements. When looking at the S&P 500, just pop on your indicator or just use your own marked up chart to make sure you know where the structural smart money buy levels are inside the market. We're coming up on the S&P 500 to very good levels of smart money buy support. However, if we were to cut through these, that paints an entirely different picture. You must be reactive to what happens with smart money buy and sell levels. Also, keep your eye on the TM6 chart. This tells you if fear is coming up or not. Junk bonds are recovering. If the major indices are starting to break down, there's weakness in oil, and oil is by nature a mover with inflation. This is inflationary, make no mistake about it. Also, yields are very important to understand, especially if you're in commodities, and also any DXY, US dollar currency index strength. The smart money buy and sell levels were released for Apple, and Apple is an overweight ETF contributor. Make sure that you keep on following what happens to this gravitational area. It is gravitational. That means even if price falls below it, it can spring back into it and even try to head for the other side. This is a very, very strong area on Apple. Looking at the NASDAQ is also quite important, and by throwing on either your indicator or just marking up your charts, you can see that there's smart money buy areas from about that 13,624 to below. This is very, very important. If we didn't have these smart money buy levels, the market would not have the structure to hold itself up. And of course, these lines are called SLs or Stanfield levels. And the chart is marked up from 1973. This is not recent indicative price. The S&P 500 is marked up since 1871. These lines are very, very powerful. US oil, which has been marked up since 1861 through the indicator, which is just part of the service. And if you're interested in the indicators, you can go across to ctksmethod.org. One thing that we saw, oil broke through this smart money one sell resistance, but couldn't turn it to support. Came back, retested, and resumed down. This is very important because this fresh air gap was saying to oil, you can blow up to around the $86 mark. Instead, it broke down. That's good, because if oil goes up, the potential for inflation to go up is very, very substantial. Also, keep your eye on gold. Here, gold is marked up with the CTKS method since 1833. And one thing that we saw, gold could not make it past this smart money buy level at 1925. It broke through a safety net and just had positive air before reaching this 1911. It couldn't hold on to the 1919 level, and it's been weakening. What you will see when the US 2-year, the US 10-year start to appreciate, start to go up in value, that puts negative momentum inside gold. You do not want the rates, those yields, to rise because it reflects inflation inside the economic system. You want the exact opposite. We want to see gold rally. Definitely keep your eyes on the smart money levels on Bitcoin, which is marked up through the CTKS method since 2009. What we've just seen is a lot of volume pile into Bitcoin. It's trying to say, this downtrend, I want it to stop. It's time for you to go up. And on what the back of everything that we've just discussed, it makes a lot of sense. But this would not be picked up by most retail investors and traders. They would see the price coming down and they would bail. Smart money doesn't do that. We understand CTKS structure. Another chart to be very mindful of, we look at Bitcoin because it's a beautiful risk on or risk off indicator, and total just tends to confirm it. When we throw on the smart money sell and buy levels, we can see where this entire structure of the crypto market currently is. Alts, Bitcoin, Ethereum, all together. Make sure that you keep passing your eye across these charts. The charts are incredibly important. They're pieces of your jigsaw puzzle. We know that no alt can escape Bitcoin's gravity. When we see the alts starting to escape Bitcoin's gravity, that means the risk-on behavior is being restored into the market. We can actually see that Solana and Tron are doing quite well. The rest of them, say ADA, Doge, BNB, XRP, and Ethereum, they're just following Bitcoin's gravitational bias at the moment. If all plays out as expected, and remember, no recession doesn't mean no recession now and immediately everything will bounce. Price is always moving in a wave. We must be patient. But we're getting green lights across the control board. There's also talk about stagflation reflections. In the 1970s, we had stagnating growth and inflation, called stagflation. You can see that that blue line represents the period from 1966 to 1982, and that's the CPI year on year. The overlay is the CPI year on year from 2013 to 2023. Are we going to get another leg up? And of course, now you know what that means. This is why understanding all of those jigsaw pieces is so incredibly important. The news will give you one, maybe two, another news source, and maybe a couple of others. But when you have all the jigsaw pieces, and especially when you know how to find them and how to interpret them for yourself, it's a game changer. When you see charts like this, it's good analysis and you must be mindful of it. There are reasons whereby inflation could increase, and we already know quite a few of them. However, the charts are independent, and when we look at the charts, they're looking really, really good, at least in the short term. If a black swan comes along, we'll just deal with it then. This is the video for LV31, and inside the Masterclass, I'll give you my live chart as well. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you in the next exciting video. Bye for now.